Question one. Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Phil Mackintosh, chief economist at Nasdaq, for a preview of third quarter earnings, as well as we'll take a look at Treasury yields and how stocks perform in a bear market. I haven't seen you in a few weeks. We have a lot to cover today, don't we? Let's talk about earnings. How, from general consensus, how positive are people on Q3?
Yes, so the good news is the forecasts are saying that the earnings recession that we've been having is nearly over. And so knowing how earnings normally work, we might actually outperform and have a start to the regrowth of the earnings cycle. So that's been really good news for the stock market and valuations. If we sort of dig down a little bit more and look at where the growth is coming from and where the growth is not coming from, healthcare is holding things back. All the COVID spending's obviously gone. Materials are struggling, and the energy sector, with oil prices actually having fallen from those sort of high levels around the Ukraine war, are all pulling the market down. Broad-based though, the rest of the economy, all the other sectors are starting to see growth already. So that's good news for companies and kind of good news for the economy too.
What's happening with Treasury yields?
Yeah, good question.
Good question.
It's super interesting right now. So we've been talking about how the Fed has been putting rates up for the last sort of 12, 18 months. And we think we're near the top. And if you look at what's happening with 2-year rates, they're not changing much at all. But what's been happening in the last 2 weeks is 10-year rates, so really long-term interest rates, have been going up really quite quickly, which isn't normal. I mean, the 10-year rate is normally the average of the short-term rates over the period of 10 years. And so if we think rates at 5.5% are going to come down in the short term, the 10-year shouldn't be getting up towards 5.5%. It should be kind of somewhere in the long-term average. And we've talked about demographics before, sort of pulling inflation back down to 2%. Inflation looks like it's already heading to 3 and maybe lower, barring oil price changes to the inflation story. So it's really a little bit weird. And there's a few theories out there. Some of it is because after we had the government shutdown, the government needed to raise a whole lot of money, which means they actually need to issue bonds, so they increase supply, and that would make interest rates go up because the prices of bonds go down. You've got a whole lot of more quant easing, so it's turned into quant tightening. And so the supply and demand has changed in a way that maybe that long end of the curve is actually just oversupplied, not enough demand anymore for those bonds. And so that makes the price of the bond go down, interest rates go up. Kind of structural, doesn't really make long-term sense at the moment unless we really do think that inflation is going to be higher for longer.
Before we get into bear market performance, I know what the data says, but anecdotally, I feel like everything is still so expensive. I can't tell you how many people I've spoken to where they just can't afford housing because of the interest rates. It feels as if things are more expensive and unaffordable than it ever was before.
Yeah, so housing is obviously really affected by the interest rates because mortgage rates are now 7.5%. They were like 3.5% a year or so ago. So that's made doubled the cost of a mortgage. If you look at the prices of houses, they haven't come down enough to offset that. So affordability for housing right now is even worse than before 2007 when it caused the credit crisis. Things are a bit different though because everyone's locked their rates in for 30 years. And so what's happening is people don't want to leave the house they're in with their low mortgage rate.
Right.
So it's meant that there's no actual new supply of houses. I wouldn't want to be someone trying to buy a house for the first time, but if you've got your house and you've locked your mortgage in, you're actually okay, and you're still paying the old rate from a couple of years ago. So it hasn't had as much of an impact as you'd think. Other things like gas prices have come back down, food prices are starting to come back down. Like a lot of the inflationary items are starting to come back down to normal levels though.
Looking a little bit longer term, this might be an abstract question. If you got a home, you're paying 6.5%, 7.5%. Should we get a recession or some sort of correction like we saw, perhaps not as big as a financial crisis? If you're paying that rate and your housing value plummets, wouldn't that put you underwater in your mortgage, or wouldn't it flip the equity picture?
That's kind of what happened in 2007, where people had been sort of leveraging their house up and doing equity mortgages on top of their real mortgage. And then as soon as the house prices went down, the mortgage was worth more than the house, and people sort of said, here's my keys. The story right now is a lot of people are actually in the money on their house, so house prices could come down quite a lot before you're actually in that position. And because everyone's got their rates locked, it's not like in 2007 when after 3 or 5 years you had to reset to the current market rate. It looks like we've got sort of 25, 30 years runway until people's mortgages start to reset. So it's a totally different environment here than it was in 2007. There's a few countries around the world where it's a bit more the opposite. UK, Sweden, some of those countries, maybe a little bit Canada, which are more exposed to the interest rate story affecting houses and affecting the economy. But here there's different things going on.
How do stocks perform in bear markets? I always find this chart to be interesting.
I know, right? So, I mean, what's the stock market telling us? And a common phrase would be that stock markets have predicted 9 of the last 6 recessions. So they're really good at predicting when things are going to slow down, sometimes too good. And so what we do in this chart is we're actually looking at bear markets, but not all bear markets actually forecast a recession. Sometimes they're a bit wrong. And so the blue line and the blue area is a bear market that turned out to be a soft landing or not a recession. And the red line and the red area are bear markets that actually turned out to be forecasting a recession correctly. And so where we are right now is actually pretty close to the soft landing line. Having said that, the little drawdown that we've seen is all because of what we've been talking about today, that interest rate hike that's happening on the long end of the curve obviously affects valuations, especially of growth companies. And so what's happened just at the last sort of 2 or 3 weeks in that black line, pulling it away from a soft landing, is the increase in long-term interest rates, which to your point could increase the risk that we actually do have a recession or that we have a policy error from the Fed, who sort of keeps talking tough, even though people are eventually going to have to refinance to higher rates, and it really is going to have a bit more pain on the economy.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.